How do you invest in stocks during a recession? Investing in individual stocks is one option. You can open a brokerage account on platforms like Fidelity, Vanguard, fund your account, and choose the stocks you like. The other option is that you invest in mutual funds that track specific sectors. Companies that sell their shares on the stock exchange are broken into sectors. Sectors are groupings that pertain to the type of business the company engages in. There are 11 sectors in total: communication services, consumer discretionary, consumer staples, energy, financials, healthcare, real estate, industrials, information technology, materials, and utilities. Delia Fernandez, a certified financial planner and owner of Fernandez Financial Advisory in Los Alamitos, California, points to the healthcare and consumer staples sectors as the best performing sectors. Those two industries remain relevant regardless of economic conditions. The healthcare sector includes biotech and pharmaceutical companies. The consumer staples sector includes food and beverages, household items, personal products. It also includes alcohol and tobacco. These sectors typically don't see the rapid growth that others, such as tech, might have in the recovery phase, but during a recession, they are typically very stable. And also keep in mind that past performance doesn't guarantee future results. Still, these are data points that might inform your eventual picks. Investing in funds such as exchange-traded funds and low-cost index funds is often less risky than investing in individual stocks, something that might be especially attractive during a recession. Investing in funds gives you exposure to specific baskets of securities. In times of recession, this is one way to invest in several companies in the most resilient sectors while avoiding concentrating the risk in any one company. If one company in the fund performs poorly, the strong performances of other companies can offset any potential losses. Vanguard has Consumer Staples ETF in the Consumer Staples Select Sector, which is a SPDR, basically a spider fund. Both of these funds include holdings in Procter & Gamble, Coca-Cola, Pepsi, Costco, and a host of other consumer staple companies. You can also invest in funds that track the whole S&P 500. This tracks the performance of 500 of the largest U.S. public companies by market capitalization or the total value of their publicly traded outstanding shares. Because it gives companies proportional sway over the index's performance based on their market cap, the S&P 500 is strongly influenced by the performance of its largest companies. There's also many funds to choose from. There's the Vanguard Consumer Staples ETF, Consumer Staples Sector Spider Fund, Fidelity has a 500 index fund, Schwab has a 500. I mean, the list goes on and on. You need to do your research. The other thing you might want to look at is a dividend ETF. Dividend stocks are shares of a company that splits a portion of its profit with all its shareholders based on the number of shares each investor owns. Investing in companies with a strong track record of paying and increasing dividends can lead to stable cash flow even during recessions. While these payments can be taken out as cash and used as income, you can also reinvest in the same stock. Even if the value of the stock is down because of the conditions, the reinvestment dividends lower the volatility. Let's say the stock market is down 10%, but that stock you have pays a dividend of 3%. If that gets reinvested, you don't experience as much downside, and you're also buying that stock at a cheaper price. When searching for dividend-paying stocks, it's important to know that the yield should be the biggest determining factor, as the highest yields tend to come with the highest risk. Rather, look for consistency in paying or increasing dividends, which is indicative of good corporate governance. Continue watching the series. We'll soon get into cryptocurrency, REITs, and a lot more.